Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on impairment of assets, IAS 36. And then we are going to look at allocation of impairment loss to non-current assets. And then also we are going to solve a question that involves discounting in order to arrive at the value in use. Okay, so if today is your first time of joining us on this channel, I will just entreat that you subscribe to the channel, share this video, like it, comment and let us know how it has helped you so that it will encourage us to do more for you. All right, so we are going to solve a question that involves allocation of impairment loss. And then we are also going to solve another question that involves using the discounted cash flow method to find your value in use and thereby finding the recoverable amount. And so without wasting much time, let us look at our first question, which involves the allocation of impairment losses. An entity has net assets with a carrying amount of 420,000 Ghana cedis. Value in use has been calculated as 480,000 Ghana cedis. Several years earlier, the entity had acquired another business. The carrying amount of the purchased goodwill arising on the acquisition is now 40,000 Ghana cedis. At the time of acquisition, the original business had internally generated goodwill of 200,000 Ghana cedis. Calculate the impairment loss and show how it will be allocated. All right, so this is a very simple question. What we actually do is that when impairment loss are recognized for a cash generating unit, we try to allocate the loss to the assets. For example, if there are more than one asset to the cash generating unit, if you have, let's say, you have PPE of, let's say, 200, for example, and then you have goodwill and other intangible assets like goodwill for 50, and you have patents for, let's say, $30. What we are going to do is that it means that for this whole asset group, we have $280 for the asset group. Now, when we carry out an impairment test on this whole cash generation unit and we realize that the asset has impaired by $40, it means that if you take out $40 from the 280, you are supposed to have a net carrying amount after impairment of 240. Now, the question now comes that we have just subtracted $40 of impairment from 280, and then we are having 240 as the net carrying amount of the whole asset group. But this $40 of impairment, where are we going to take it out from? Because it's supposed to reduce the value of the asset. Now, the general rule is that we are supposed to reduce the value of the intangible assets first before we touch the tangible non-current assets. And so we can say that this whole 40 will be subtracted from the $50 so that the goodwill component will now be 10. Or we can share them based on the proportion of holdings, a weighted average proportion. Or we can even share 20 each. Sometimes it depends on the criteria that you want to use as a company. But the normal thing and the best thing to do is to make sure that this 40 is going out of the intangible assets, while your tangible non-current assets remain intact and untouched, except you have an impairment loss of, let's say, $90. If you have an impairment loss of $90, then it will be allocated such that this 30 and 50 will go off. You will still be left with $10 of impairment, which you can now subtract from your PPE. And so the PPE's value will reduce to 190. But the extra 80 had already been taken out from the goodwill. And so we can now say that if our impairment loss is 90, then the total value of this cash generating unit will be 280 minus 90, which is 190. So, but in the allocation of this 90, we will take all the rest 30 out. We take out all these 50, and the 10 that will be left will now be subtracted from the PPE. That is what we mean by allocation. Now, if you look at this question again, we are told that An entity has net assets with carrying amount of 420,000 Ghana cedis. So the carrying amount or the net book value of the asset is 420,000 Ghana cedis. And we are also told that value in use has been calculated as 480,000 Ghana cedis. Now, we all know that to find your impairment, it is the carrying value of the asset minus its recoverable amount. And so for a quick recap, we know that impairment loss or impairment test is carried out by taking out, this is the CA means carrying amount minus the recoverable amount of the asset, where the recoverable amount is the higher of the net realizable value, which we call the fair value less cost to sell, and then the value in use. Okay, and so between the value in use and then the net realizable value of the asset, the highest value becomes the recoverable amount, which we eventually take out from the carrying amount of the asset to get the impairment loss. When the recoverable amount is bigger than the carrying amount, there is no impairment, because I told you in the part 1 that we don't have anything like an impairment gain. All right, and so that is what we are going to do. Now, in this question, we are told that the carrying value of the asset is 420,000 Ghana cedis. And then we have been given the value in use as 480,000 Ghana cedis. But we have not been given any net realizable value. And because we have not been given any net realizable value, automatically, this 180,000 will move up to become the recoverable amount. Now, if you look at it straight like this, your carrying amount of the asset is 420, your recoverable amount is 480. Automatically, there is no impairment if you look at it this way, because the carrying amount or the recoverable amount, is higher than the carrying amount. But there is more to this carrying amount that I want us to continue reading and discover. We are told that the carrying amount of the purchase goodwill arising on acquisition is now 40,000. Okay? At the time of acquisition, the original business had an internally generated goodwill of 200,000. So it means that to get the carrying amount of the assets, because this asset that we are talking about is not just a single asset, we are talking about net assets of the business. Okay, so this 420 refers to the carrying amount of the entire net assets of the business or the entity. And if the net assets value is 420,000, but we are told that when we were acquiring the entity, we purchased goodwill of 40,000 Ghana cedis. So this is purchased goodwill. Okay, and when we were buying, the business that we were acquiring also had an internally generated goodwill of 200,000 Ghana cedis. Internally. So this is purchased, this is internal, but they are all goodwill. Then it means that, truthfully, the actual carrying amount of the net asset of the business will not be just the 420,000 that we know, but then we need to add these goodwills. First of all, we have 200,000, which is an internally generated goodwill by the business we went to acquire. And we also have a 40,000 that we also paid as the excess of our purchase consideration over the net carrying amount. Okay, so we have a purchase goodwill of 40, internally generated goodwill from the business of 200,000. So when we add that to this net asset, we are going to have 660,000 Ghana cedis. So like I told you earlier, if you look at 420,000 and compare with the recoverable amount of 480,000, you are going to be tempted to say there is no impairment, because the recoverable amount in this case will be higher than the carrying amount of the net assets. But the question gave further clarifications that necessitates the fact that we need to factor both goodwills, both the purchase goodwill and the internally generated goodwill from the original business that we bought. And when we add them, it's going to shoot up the value of the net assets to 660,000. And once the value shoots up to 660,000 for the net asset, then it means that the recoverable amount becomes lower than the entire net assets value. And that means that there is a possibility of impairment now. And so this 660,000 minus the recoverable amount of 480,000 is what is going to give us our impairment loss for this question. So the requirement is that calculate the impairment loss. That is the first one. And show how it would be allocated. And so to calculate the impairment loss, it is your carrying amount, which is now 660,000, minus the recoverable amount, which in this case is 480,000 because there was no value, there was no net realizable value in the question. So automatically, the value in use pushes up to become the recoverable amount. And when you take 480,000 out of 660,000, you have an impairment loss of 180,000 Ghana cedis. So that is your impairment loss. So that is the first requirement. So we can present it in a better way. This is the answer, but I can do a proper presentation for you by calculating this and then taking out that to get your impairment loss. I hope it is very understandable. And so this is the solution for the first part for calculating the impairment loss. But I'm going to clean this and then do a proper presentation for you. We are going to say that the net assets of the business includes the original net assets of 420,000 Ghana cedis. And then we will have the purchase goodwill. The purchase goodwill was 40,000. And then there was an internally generated goodwill, which we took over from the existing business. And that was 200,000 Ghana cedi, giving us a total net asset of 660,000. So we have 660,000. So this is for the net asset. And then we can say that to calculate for impairment loss, it is your net assets value, which is now 660,000, minus the recoverable amount, which we have explained to be 480,000. That is for the value in use. And so when we subtract, we have 180,000 Ghana cedis for impairment loss. This is a nice way to do your presentation. So after you have this, the next sub-question is to show how it will be allocated. All right, so to show how it will be allocated, this loss of 180,000, I've explained to you earlier that we need to first, because impairment loss will reduce the value of the assets, and the value of the net assets is 660. When it's reduced by impairment, we are going to have the recoverable amount. That is the meaning. It means that the recoverable amount actually means that the value of the net asset should be equal to the recoverable amount after subtracting the impairment loss. And so what we are going to do is that this 180,000, where are we going to take it out from? I have told you that unless these intangibles are done or it's finished, you do not touch your tangible not net assets. So what we are going to do is that we are going to subtract this 180 from these two. They are all goodwill. And so one is an internally generated one is a purchase goodwill, summing up to 240,000. So we can allocate it on a pro rata basis. What do I mean by pro rata? On a ratio based form. So we can say 180 over 240. If you add these two goodwill values, you have 240,000. And then the loss you are trying to clear off is 180,000. And so it's going to give you a ratio. So you can use that ratio to do that allocation. So 180 over 240 gives us 3 over 4, meaning that we are going to use 3 over 4 as the ratio for allocation. So that is the meaning. To get the ratio, it is the impairment loss, then you can divide by the value of the intangibles. So what we are going to do is that for every 4, we are going to eliminate 3, because that is the goodwill and the total goodwill and then the loss. And so to know how much will go out of the purchase goodwill, it will be 3 over 4 times 40,000. Meaning that you are taking out 30,000. And then to know how much will go out of the internally generated goodwill is 3/4 times 200,000. And that gives you 150,000. So that you know you are taking out 180,000 from the value of the asset because it has been impaired. But you are taking them out in this proportion, in the proportion of the existing. And so I'm going to also do this thing I'm done in a proper presented way. So I'm going to present it properly and then show you how this allocation will be done. Okay. Okay, so this is what we are going to do. I'm going to say before impairment. I'm trying to present it in a nice way. Then I'll say loss. Then I'll say after impairment loss. So let me show my currency sign for each of them. Now look at what I'm going to do and how I'm going to do this allocation. I'll say net assets, original net assets before impairment was 420,000. But I told you we are not allocating any loss to it. The only time we will allocate loss to this original assets is when we have exhausted, the loss is so big to the extent that we have exhausted all the goodwill and the other intangible assets before we come to these tangible ones. So there will be no loss allocated to the net assets, the original net assets. So even after impairment, we still have a value of 420,000. Then let's also talk about the purchase goodwill. Before impairment, the value was 40,000. We just calculated that we are allocating 30,000 loss to this. So it's like a negative something. So when you subtract that out, you'll be left with only 10,000 Ghana cedis for the purchase goodwill. And then finally, we have the internally generated goodwill. That was originally 200,000. But we are allocating a loss of 150,000 as per the calculation we just made. So when you take 150,000 out, you'll be left with a balance of 50,000. So this is how you are going to do the allocation. We subtract them from the intangibles before we even think about the tangibles. And so when you are done with that, you see that originally your total is 660,000 before impairment. Then the impairment loss itself is 180,000. Then after impairment, if you add these three, you are going to have 480,000. So it means that after impairment, the total value of your net assets will be 480,000, which is equal to the recoverable amount. Because we have said that the value of non-current assets or assets should not be carried in the books beyond their recoverable amount. And that is why we do impairment tests in the first place. So that if the value of the asset is going beyond the recoverable amount, we slash that off and make sure that at least the value of the asset is exactly their recoverable amount or less than that. So that is how we go about. So this is the final stage of this simple illustration. You first need to calculate your impairment loss, and after that you show the examiner how you do the allocation. Okay. Now, there is one important thing that I have not said. You see, we have loss allocated to two different goodwills. One is the purchase and then one is the internally generated goodwill. Remember that this internally generated goodwill was not generated by the business. According to the question, it was generated by the original business that where we bought it from. It's coming from that place. Okay? And so what we are going to do is that the loss of 150,000 on the internally generated goodwill will not affect the financial statement. It's not going anywhere. But the loss of the purchased goodwill will be recognized in the income statement. That is the meaning. We are going to recognize this as an impairment loss in the income statement. But for the internally generated goodwill, the 150,000 will not be shown anywhere in our financial statement. Because we didn't, the reason being that when we were buying the asset, we only knew this value and we bought in excess of 40,000. So in other words, it's like we were aware that this was the value of their net assets and we paid 40,000 extra. So that is a transaction. It was an outflow from the business. And so the impairment needs to be recognized to show that downward flow. But the IG goodwill, there was no record of that. It is just there for the purpose of what we are doing. And so when you are doing your financial statement, because the new business did not part away with cash to purchase this goodwill, we cannot show the loss of it in our financial statement. So we are going to recognize this in the financial statement, but this goes nowhere in the financial statement. And I have always told you that in questions like this, especially with accounting standards or IFRS questions, you will calculate, but most of the time your calculations are not just enough. You need to do some writing. So mostly they will tell you to advise the business. So after this, that is the part where you are going to advise. So you are going to tell them that they have to recognize this in the income statement as a loss, but they are not supposed to touch that because they did not buy that. There was no cash outflow in the purchase of the internally generated goodwill. All right, so that is the question for you. So having understood this type, we are going to look at another question, but this time we are not focusing on allocation of losses. We are going to look at how to use the time value of money, the discounting cash flow method, to calculate our value in use. All right, so we are going to take a question where we are going to focus on how to use the discounted cash flow method to calculate and get our value in use. For almost all the questions that we have answered so far, the value in use has been given to us. So we are going to look at a situation where you'll not be given the value in use, but you'll be given estimated cash flows for the future. And then you are going to use the discounted cash flow method, discount them to get your value in use, just as we do with time value of money. And that is exactly what we are going to do. We are going to apply our knowledge in financial management to this question that we are going to solve. So let us look at this question without wasting time. Sabah Timber Limited produces and exports lumber and planks. It owns a plant which has a book value of 1.8 million Ghana cedis as at 1st January 2020. The government of Ghana passes a legislation that restricts the exportation of lumber. Consequently, STL has to reduce production by 40%. Cash flow forecast for the next 5 years included in the budget submitted for management approval in January 2020 shows the following. So we have these cash flows. In the year 2020, 552,000. In the year 2021, 506,000 Ghana cedis. That is the cash inflow. We are expecting 2022's cash flow to be 376,000. And then 2023 to be 250,000 Ghana cedis. And then 2024 to be 560,000 Ghana cedis. The cash flow forecast for 2024 includes expected proceeds from the disposal of the plant. The cash flow projections also ignore the effect of general upward movement in prices. It is estimated that if the plant is sold in January 2020, it will realize a net proceeds of 1,320,000 Ghana cedis. The cost of capital for STL is 15%, ignoring inflationary effects. Required. Calculate the recoverable amount of the plant and impairment loss, if any. Okay, so this is the question. We are supposed to calculate any impairment loss after calculating the recoverable amount. Now, this question requires you to apply the discounted cash flow method. We are told that the company is into lumber production, a timber company, and they export it. Now, they have made a projection of cash flows for the next 5 years, beginning from January of 2020. And the estimated cash flows, they have also given you a discounting factor, which is 15% cost of capital. Now, we know that everything about impairment is that we test for impairment by comparing the recoverable amount of the net asset to the carrying amount, okay? And to get the recoverable amount, the standard says that the recoverable amount is the higher of fair value less cost to sell and the value in use, as we explained in the part 1 of this video, okay? And the fair value less cost to sell is also what we call the net realizable value, which we have been given in the question as 1,320,000. So this is the net realizable value, or the fair value less cost to sell. Now, the value in use, which we call the entity specific value, we don't know. We are supposed to find the entity specific value, or what we call the value in use. And we need to do a discounting, because we are told that the value in use of the asset is the present value of the future cash flows that will be generated from the expected use of the asset. Okay, so as we continue to use the asset, the projected cash flows, we have to discount them into today's term and find the total, the present value of each of the discounted cash flows. And that is going to be our value in use. And once we have the value in use, we compare the value in use to the net realizable value, or the fair value, which is less cost to sell. And the higher of the two becomes the recoverable amount. Then we can compare the higher of these two, to the carrying amount of the asset, or the net book value. And the carrying amount of the asset has been given to us in the question as 1.8 million. So this is the carrying amount of the asset. But we have been given the net realizable value. We have not been given the value in use. You see, this could have been very easier if we were given the value in use. Then we will compare the two and take the higher amount. Then the higher amount will now be called the recoverable amount. We compare that to the carrying amount, and if it is lower than the carrying amount, the difference becomes impairment loss. But everything has been given except this. And so we cannot find our recoverable amounts now, because the higher of the two must be called recoverable amount. And how are we going to find this? We need to do a discounting. So we are going to use the Dcf approach. And so I'm going to clean this, and I'm going to use this part of the board to do the discounted cash flow in order to arrive at our value in use. Now listen, let me also highlight some important aspects of the question so that you will not be confused. We are told that, as for the introduction, it doesn't really have much impact on the cash flows. But the only thing that we are told is that we are ignoring inflationary effects. Okay? We are ignoring inflationary and upward movement in prices. So all that we are trying to say is that this is DCF, or discounted cash flows, without inflation. And so the discounting rate is not going to be affected by inflation rate. And that is an advanced financial management technique, which we are not going to use here. Okay, so we are going to look at the normal financial management technique of discounting cash flows. And so that is what we are going to do. So let us try discounting these cash flows to find our value in use. And so this is the normal formula or approach. You say year, then cash flows will come in Ghana cedis. And then the discounting factor is the next, which is 15%. And then the present value will also be shown. So this is how to go about it. So the years are 2020, 2021, 2022, 2023, 2024, 5 years. Then the cash flows were given to us in the question. So we are going to pick the cash flows directly from the question. 552,000 for 2020. 2021 is 506,000. Then 2022 is 376,000. 2023 is 250,000. So 250,000. And then finally, the last year, 2024, which includes the expected proceeds from the disposal of plant, is 560,000. So these are the cash flows given to us. Now, with a discounting factor, if you have not understood how to discount, then look at it very carefully, because 15%, this is how to go about it. The formula for finding the discounting factor is supposed to be 1 over 1 plus r, all raised to the power n. The denominator raised to the power n. This is how to go about the discounting factor. 1 over 1 plus r raised to the power n, where r is the rate which is the discounting factor, 15%, that's the R. And the N is the number of years. So this is how to find the discounting factor. Because at the end of the day, we need to get the discounting factors and multiply each of them by the cash flows to get their present values. We are bringing them back. You know, with the time value of money, you try to bring them back to today's terms. And so that is how to go about it. And so if you take the discounting factor for year 2020, now this is how we are going to look at the number of years. 2020 will be regarded as year 1. 2021 will be regarded as year 2. 2022 is regarded as year 3, year 4, and year 5. And so the N for this year will be 1. And so if you are trying to get the discounting factor for 2020, it's going to be 1 over, I'm just using that as an example, 1 over 1 plus R. The R is the rate, 15%, which we are going to write as 0.15 all over, all into brackets, raised to the power 1, because N is now 1. So when you punch this on your calculator, it will give you a value, and then usually when we are discounting, the value you have will be in decimals. So you limit them to 3 decimal or 3 significant figures. Okay, so what we are going to do is that the first one is going to give us 0.870. You can try that with your calculator. This is how it's going to give us for the first year. And then for the second year, it's going to be the same thing, 1 over 1 plus 0.15. This time it will be raised to the power 2. The denominator will be raised to the power 2 because we are in the second year, so number of years is 2. And so when we do that, it's going to give us 0.756. Then we change the number of years to 3 and we punch the same way. We have 0.658. And then when we do for the fourth year, we have 0.572. And then the last year, the discounting factor becomes 0.497. So these are the discounting factors for each of the years. I'm sure it's very understandable. And then we are on the final stage of getting the value in use. So what we need to do is to multiply each of these cash flows by their discounting factor to get the present values of the cash flow, because all these things are in future values. Now listen, this is the idea of the present value. 376,000, we are expecting to get that in 3 years' time. The value of 376,000 in 3 years' time will not be the same as the value of 376,000 in today's time or in present day. So we discount them back using the company's cost of capital into today's terms so that we can know the actual value of the asset in today's terms. Yes. So what we are trying to say is that we multiply 552 by 0.870, sorry. And that is going to give us 480,240. 480,240. And then we have 506,000 multiplying 0.756. That gives us 382,536. And then also we have 376,000 multiplying 0.658. That gives us 247,408. And then finally, we have 250 multiplying 0.572. That gives us 143,000. And the final one is 560,000 multiplying 0.497. That gives us 278,320. So these are the present values of the future cash flows. Now, the value in use is the total of the present values of all the estimated cash flows. So we have to find the total. And the total of all these present values will now come and replace as the value in use. And so when we add them up, what are we going to get? We are going to get 1,531,504. So this is going to be the value in use. So we use the discounted cash flow approach to find our value in use. And that is what we are going to do. So now we have been able to estimate the value in use. So we can now test for impairment. And so we are going to find our impairment loss. Now, the impairment loss is the difference between the carrying value of the asset. So the carrying value of the company's net assets is 1.8 million. Then we take that from the recoverable amount to see if there is an impairment loss. Now, how are we going to find the recoverable amount? We are told, let me clean this side. We are told that the recoverable amount is the higher of your net realizable value and your value in use. Your value in use is also called the entity specific value, in case you want to know. Now, in the question, we are given the net realizable value to be 1,320,000. And then we just calculated the entity specific value to be 1,531,504. Now, according to the IFRS or the standard IAS 36, the recoverable amount of an asset is the higher of the net realizable value and the entity specific value. So if you compare these two, the higher of them becomes your recoverable amount. And looking at these two, it is clear that the value in use or the entity specific value is higher. And so we bring the same value here as the recoverable amount, which is 1,531,504. So once the recoverable amount is less than the carrying amount, there is an impairment loss. If the recoverable amount had been higher, then there will be no impairment. And so impairment loss is the excess of the carrying value of an asset over its recoverable amount, as we have already explained in our previous video. And so once we take this out, we get the final value, which we call the impairment loss. And that is 268,496. This is the impairment loss. Okay. This is the impairment loss that we have fulfilled the requirement, which says that calculate the recoverable amount of the plant and the impairment loss. So this is the recoverable amount and this is the impairment loss. And we have to go through the discounting approach to get a value in use. Okay, I don't think impairment is a very difficult topic. And this brings us to the end of the part 2 of our video on impairment. In fact, I'm going to release the part 3 very swiftly, I'm sure. And it's not that much of a big deal. It's just that I have to touch on one or two things concerning reversal of impairment loss and the disclosure requirement. Other than that, I would have been done with impairment. And this is a very simple topic that I am sure that even as at now, you are fully prepared to face any exam where you have impairment. Remember to subscribe to the channel, as I said. Share this video and let others also have a benefit. And until we meet again for another video, it is bye for now. Thank you.